Welcome back, everyone. Today, we're diving deep into a topic that's often overlooked but can have a major impact on your long-term portfolio growth: combining dividend-focused ETFs with covered call strategies. We're going to explore why simply chasing high dividend yields isn't enough, why portfolio sustainability matters, and how you can structure a portfolio that not only generates solid income today, but continues to grow over the next decades. Specifically, we'll look at SCHD, the Schwab U.S. Dividend Equity ETF, as the foundation, and discuss which covered call ETFs might complement it to enhance your yield without sacrificing stability. Even if you don't have anything to show on screen, don't worry. I'll guide you through every step, and by the end, you'll understand how to approach a two-fund portfolio that balances growth, income, and risk management. This video is for informational purposes only and is not financial advice. Always do your own research or consult a professional before making any investment decisions. Let's start with SCHD. This ETF is a staple for dividend investors because of its strong history of dividend growth and relatively steady returns. To get a sense of the yield, you can bring it directly into your spreadsheet using tools like the Ticker Data add-on in Google Sheets. All it takes is selecting SCHD, pulling the dividend yield, and hitting Enter. What you'll notice is that the backward-looking yield is roughly 3.33%, though forward-looking projections can be slightly higher. Historically, the dividend growth has averaged around 11%, and in recent years, it's been slightly above that. This makes SCHD a reliable starting point if your goal is long-term dividend accumulation. But here's the thing. While SCHD provides consistent growth, its yield isn't extremely high. This is why some investors consider pairing it with a covered call ETF. The idea is simple. Add a fund that can provide a higher yield while maintaining some level of sustainability. The challenge, however, is that not all covered call ETFs are created equal. Let's talk about what to watch out for when evaluating covered call ETFs. A common misconception is that all high-yield covered call ETFs are good investments. Many of them offer double-digit yields, which look attractive on paper, but the reality is that sustainability often suffers. If you look at the net asset value of most of these funds over time, you'll notice that many have declined over the past year or even since inception. Why? It often comes down to portfolio options coverage. Most covered call ETFs maintain 100% coverage, meaning every single stock in the portfolio has an option sold against it. While this generates consistent income, it can cap long-term growth and even reduce dividends during down markets. On the other hand, some funds, like those from NEOs, have managed this better. For example, their SPYI fund has grown in net asset value over time, though it benefits from the broader S&P 500 bull run. Similarly, QQQI has delivered a trailing 12-month yield of 14.33%, but we need to understand the underlying risks and sustainability of these returns. One of the critical points when adding a covered call ETF alongside SCHD is diversification. SCHD's portfolio is heavy in value stocks like Lockheed Martin, Texas Instruments, Chevron, Verizon, Merck, and Coca-Cola. On the other hand, a tech-heavy covered call ETF includes names like Nvidia, Apple, Microsoft, Amazon, Meta, Google, Tesla, Broadcom, and Walmart. By combining these two ETFs, you achieve a complementary diversification. SCHD provides steady dividend growth, while the covered call fund provides higher yield from a different sector exposure. After evaluating several covered call ETFs, one fund stands out for its combination of yield, active management, and sustainability: the Goldman Sachs NASDAQ 100 Premium Income ETF, ticker GPIQ. At first glance, it may look similar to other covered call ETFs, but it employs a dynamic options override strategy that sets it apart. Instead of covering the entire portfolio, the fund sells call options on a varying percentage of the market value of its holdings, usually between 25% and 75%. This allows the portfolio managers to adjust exposure based on market conditions, implied volatility, and outlook, protecting the net asset value while still generating meaningful distributions. What does this mean for investors? Essentially, the fund can participate more fully in market growth, preserve capital during downturns, and offer a level of dividend growth that's rare in covered call ETFs. The trade-off is that the starting yield is slightly lower than more aggressive funds like QQQI, around 10.31% trailing 12 months. However, the sustainability and potential for modest dividend growth make it a compelling choice. Let's bring this together with a hypothetical portfolio. Imagine weighting SCHD at 70% and GPIQ at 30%. Using historical dividend growth and price appreciation estimates, let's assume 8% annual growth for simplicity, we can model the outcome over a 30-year period. Starting with a $100,000 investment, the initial dividend income would be around $450 per month. Within 5 years, this could grow to over $850 per month, with total dividends received reaching almost $38,000, while the account value would increase to roughly $192,000. By year 15, monthly dividends could exceed $3,100, with cumulative distributions over $250,000. What this shows is the power of combining a stable dividend ETF with a sustainably managed covered call ETF. You're enhancing the starting yield without sacrificing long-term growth, creating a snowball effect where dividends generate more dividends over time. Another advantage of GPIQ is its tax treatment. Much of its income qualifies under Section 1256, which can be more favorable than ordinary income. This adds another layer of efficiency for investors seeking consistent income without being overly burdened by taxes, a point often overlooked in traditional dividend investing strategies. It's crucial to consider the current market environment. U.S. equity risk premiums are in negative territory, meaning you're taking on more risk for less potential reward. Valuations are stretched relative to interest rates, so forward-looking returns may be muted. This highlights why sustainability and risk management are key when building a dividend-focused portfolio. Funds like GPIQ, with active management and adaptive options coverage, are better positioned to navigate market pullbacks than more rigid or highly aggressive covered call ETFs. To summarize, here's what we've learned. SCHD is an excellent foundation for dividend growth, but has a moderate yield. Not all covered call ETFs are created equal. High yield often comes at the expense of sustainability. Diversification between value-focused and tech-heavy portfolios can enhance risk-adjusted returns. GPIQ's dynamic options strategy allows for a balance of yield, growth, and sustainability. A combined two-fund portfolio can generate meaningful, sustainable dividends while maintaining growth potential. Tax efficiency and active management further enhance long-term outcomes. By carefully selecting ETFs and structuring allocations thoughtfully, you can build a portfolio that maximizes income without sacrificing the potential for long-term capital growth. This approach isn't about chasing the highest yield, but about achieving reliable, sustainable results that allow you to sleep well at night, knowing your portfolio is designed to weather market fluctuations. Investing isn't just about chasing numbers on a screen, it's about understanding how each fund operates, how option strategies affect growth, and how different sectors contribute to a balanced portfolio. SCHD provides a strong, steady foundation, while GPIQ adds yield and diversification with an intelligently managed approach. Over decades, this combination can compound into substantial income, providing both stability and growth in uncertain markets. So, if your goal is to enhance dividend income while keeping sustainability in mind, a thoughtfully constructed two-fund portfolio like SCHD and GPIQ is an excellent strategy. Remember, it's about long-term consistency, not chasing the highest monthly payouts. With careful planning and an understanding of how covered call ETFs function, you can create a portfolio that grows, generates meaningful income, and remains resilient through market ups and downs. Thanks for watching. If you found this helpful, don't forget to like, subscribe, and hit the bell so you don't miss any updates. See you in the next video.